The following is a paid commercial announcement. The ideas and opinions addressed in this show do not reflect the views of WKBK or Saga Communications. From the Davis Oil and Propane Company studios, it's time for Financial Wellness Weekly. The opinions voiced in this broadcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Time now for Financial Wellness Weekly on WKBK.
Securities and investment advisory services offered through LPL Enterprise, a registered investment advisor, member FINRA SIPC, and an affiliate of LPL Financial. Financial professionals are licensed insurance agents of Prudential. These financial professionals are permitted to brand under Prudential. LPL and LPLE Financial are not affiliated with Chartered Financial Services or Prudential. Individual tax and legal matters should be discussed with your tax or legal professional. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible risk of loss of principal. Welcome to Financial Wellness Weekly on Keene's news station, WKBK. This is Liz Newcomb with Chartered Financial Services, and
I'm John Benton.
And today we're very excited because it's the first time that the founder of our firm, John, is with us in person. And we are going to be talking about life insurance today. But before we get into it, we would love to hear from you, John, a little bit about yourself, your background, and yeah.
Terrific. Well, thanks, Liz. It's good to be here. Good to be here. So there's a bunch to talk about by way of my background, but we'll separate it into personal and professional. I was born in New Jersey, in Edison, New Jersey, named after Thomas Alva Edison, the inventor of the light bulb, so some people think. I lived there for all of my years up to college, and then I moved to New Brunswick and went to Rutgers University. Go RU. And I graduated from Rutgers in 1986.
Before I was born.
I hear that a lot. Just after I graduated, less than 2 weeks after, I ended up interviewing with and joining Prudential. And I started this firm inside of Prudential back in 1986.
Wow.
I shortly after that.
So you know a thing or two, John.
Yeah, a thing or two, about a thing or two. Met my wife in New Brunswick. Well, she was a girlfriend then became a wife shortly after. And we were married less than a year later. We were married in 1988. And we had our children in 89 and 91, and we moved to Chatham, New Jersey. It's a small town near Morristown, New Jersey. A lot of people have heard of Morristown.
I have some family there.
Not too far from Newark Airport, by the way, and it looks nothing like Newark in Chatham. It's a good little community. I was a volunteer firefighter there for 26 years. My wife was on the ambulance squad for 18 years. My daughter was on the ambulance squad for a number of years.
Wow.
And then after living there for 30 years, we decided that we'd like to see another part of our beautiful country, and we moved up here to New Hampshire, and we live in Spofford, New Hampshire now. We just built a house there.
Welcome.
And what a beautiful area it is. And we also decided to move our business to Keene, New Hampshire. So that's where we are now. We have a building on Washington Street, 191 Washington Street, and Liz and Nina and Tyler and I work there, and the whole rest of our firm's team still works in New Jersey. But when I began my career, I began really as a life insurance, automobile insurance, and homeowners insurance guy. And that was all I did. And I kind of stayed true to that. All I've ever done over the last 40 years has been life insurance, auto insurance, and homeowners. We no longer do auto and homeowners. And we started to focus on accumulating assets for clients and helping them with advisory business to advise them on what they do with their assets. And when we started that, Nina, my wife, joined the firm. That was in 1997, 96, 97. Yeah, she's in her 30th year now. And we really started to focus on advice, giving advice for financial planning and asset management and accumulation.
I love that you guys have like a different focus and you both have areas of expertise that just complement each other so well. And you're really good at making sure everyone in the firm has a different role so that we can just take such good care of the clients. So,
specialty, a multi-specialty firm is kind of what we call it, actually. Everybody in the firm specializes in something. Like you, Liz, financial planner. Everybody specializes. Even our service staff specialize. They handle specific things, so they're really good at what they do. And so we built the team around this financial wellness and advisory, hence the name of this show, Financial Wellness Weekly. It really speaks to what we do and how we do it. So we are committed to helping families and executives. Kind of, I'd say our sweet spot for most of the firm is working with executives and families. That's really what we do. And we help them kind of get up to and all the way through what's going to be a long retirement in their life. So that's really it professionally. What I like to do personally, Nina and I like to do a lot of outdoor things. We garden. We like to really take care of our garden, although the house is new construction, so the garden isn't too developed right now.
Although it's the time of year, are you guys planting yet?
Not yet, because they're still doing a lot of site work at the property. It's, I guess you could call it a mud hole right now. But when we spend a lot of time together gardening and working outdoors, hiking and walking. But when I'm not doing that, skiing is something that I love to do. So hence New Hampshire's a great fit for that. At least this year it was a good fit for sure. A lot of snow this year. And we also enjoy motorcycle touring. We've been all over the country. We've toured out to 34 of the states. And,
I don't know if I knew that. Maybe you told me.
And we do it around a pretty neat thing, by the way. We seek out presidential birthplaces. So like, where Calvin Coolidge was born in Vermont, Chester A. Arthur. I mean, all these presidents were born all around the country in places you never knew.
Did you see that show, by the way?
No.
About Chester A. Arthur? You should watch it.
Oh.
Really good.
All right. I will. Great. Thanks. So motorcycle touring is something we like to do. And I would say pretty much anything outdoors. Anything at all outdoors is what we like to do. So that's a little bit about me. We can continue on though with our
thanks, John.
topics.
I feel like I learn something new every time.
There you go. There you go.
So yes, we're going to be talking about life insurance today, which is John's specialty. And I thought we would start by just sharing a little bit about what is it.
Yeah. So first of all, life insurance is not the most glamorous topic. It's not something people think about every day. And why would they? There are so many other things that compete for our attention.
Not to mention we don't like to think about dying, John.
That's true. That's true. But it is something that I think about every day, all day. That's all I think about is life insurance. So I try to make it simple for folks. I try to really boil it down to what's important. And, life insurance is nothing more than a contract between a person and an insurance company that you pay the premiums. And as long as you pay the premiums, you're protected. And what are you protected for? The premature death and the financial loss associated with that premature death. Mm-hmm. And there are so many reasons why people buy life insurance, but it all boils down to one major reason. They love somebody or they love something, a charity, and they want to protect them. They want to provide for them. They want to make sure that if they die before they expected to later in life, that the family goes on with all their desires, dreams, goals, and wishes. And we have kind of a process to help people think through that. But life insurance is really, it's a simple thing. It's the contracts themselves that are a little bit complex. And that's what we try and help, the products.
And that's what we help with. Yeah.
That's what we try to get them through. Yeah.
So it's really very simple, I guess, when it comes down to it. It's just making sure you're not leaving your loved ones without the money that they need to take care of their needs and their desires, really. Right?
You hit it right on the head there, Liz. Needs and desires. That's what we focus on. So the needs are things that are really relatively easily quantifiable. So I've developed this kind of process over the years. And when we talk about needs, we talk really about 5 basic needs that just about everybody has. Not everybody, but just about everybody. And those are into two categories: cash needs and income needs. Cash needs, we like to make sure that people have a lump sum of dollars available to pay for the things that are going to be due over the shorter term of their life, such as the obvious when somebody dies. There's the funeral. There are all the final expenses that go along with it. There is the big open party after the funeral. It's, these things are very expensive. And having recently paid for a funeral of a family member, I know they're very expensive. And we want to make sure people have enough dollars set aside so that when they die, there's enough money to cover funeral and other final expenses. But then there's debt. Debt has so many forms.
Right.
There's mortgage. Everyone thinks about mortgage. There is private debt. There is credit card debt. There are car loans. There are business loans. There are loans that you may have co-signed for somebody.
Student loans.
Student loans. Yeah. And these student loans these days are huge. Kids are graduating from college with gigantic debt. And so a lot of times a parent would want to have that settled for them if the parent dies. So it's final expense. It's debt. And then there's the cost of education. If you're planning to educate a child, whether it's in to college or trade school or some other higher education, or even through high school, you want to make sure those dollars are there so that education can continue and the family's goals and dreams are continued. So it's final expenses, it's debt, it's education, and then the final cash need is to have an emergency fund. People have heard from many sources that it's good to have 6 to 12 months of living expense set aside, so you have these dollars put aside that if the roof is leaking or if the furnace needs to be replaced or both, or some emergency comes up, you have the dollars. So those are the 4 basic cash needs. And we use formulas to come up with how much insurance a person might need for that. And then finally, once we've taken care of all those cash needs, then there's the income need. If one of the two of a couple dies, the other one still has to get all the way up to and through that long retirement I spoke about during my my little bio read. And they've got to pay for all of the things that are not covered in those 4. And those things include everything from, yes, your utility bills, your cable bill, your cell phone bills, your car insurance premiums, your homeowner's insurance premiums, your real estate taxes, everything that a person needs. And it even goes down to clothing and going out for ice cream on Friday. Everything that makes life worth living is what we do. Exactly. And saving for this long retirement. So these are what we use to help people come up with what they need. And then, of course, they already have some resources towards these. So we subtract out the resources, and that gives us the idea of how much life insurance a person might need. And their resources can be anywhere from existing life insurance to 401ks to 529 plans to other things that they have to meet these needs. Long description, but it really is what we do to help people figure out their needs. And then one more thing before I end that is desires. Many people, as they get through life and have passed the point where they have no debt perhaps, they don't have to educate children anymore, they've got their emergency fund set up, they are approaching retirement, the retirement's set. Then they think, well, why do I need life insurance anymore? And you might not need it, but you might want it. You might desire it. My children will hear this, and I apologize in advance for them hearing this, but once you have grandchildren, you realize the reason why you had children. And grandchildren are an A+ reason to want to leave dollars behind. And any grandparent will tell you that.
All right. So lots of reasons why people should have it. I do hear sometimes, John, objections to needing life insurance. So one of the main ones is, well, why would I want to pay for my own policy when I have something through work already? What would you say to that?
Well, they very well may have the proper amount of coverage through work, and our needs analysis will help us determine that. But oftentimes they don't, because typically, in fact, in almost all cases, it's between 1 and 2 times income that they have for life insurance at work. So if you're earning $150,000 and your family is living on that $150,000 every single year, they need that income, and they're presented with a check on your death of $300,000, that's not going to get them very far. It won't pay for those things. So a needs analysis will help us determine it. But that's not enough, because once we do the needs analysis, generally it comes up with a large need. And if you think about all the things that we talked about for the needs, and then what we'll do is we'll determine what types of policies, but that is a larger discussion around types of policies that there are out there. Some policies are very low cost, some are not. And they're that way for a reason, which we can get into.
So you kind of start by figuring out ideally how much insurance should you have in a perfect world. And then you can kind of work backwards to, well, how much insurance can you afford, and what are the different ways we can structure these policies to try to cover as much of the need as possible while not breaking the bank.
Yeah. So budget is critical here. Understanding what a person can afford to pay, or not necessarily afford. Most people can afford the life insurance. It's what do they want to afford. So, we don't want people to not be able to go buy groceries because they bought life insurance. We don't want people to not be able to do the ice cream on Friday night, as I said, because they bought life insurance. So we want to work within a budget. We want to make sure it's affordable to them at their desired affordability level.
Okay. Should we talk about the kinds of insurance that there are, John?
Sure.
All right. Well, there's two kinds, right? There's term and there's permanent.
Yeah, permanent. Good description, good descriptive word, because most people think there's just term and whole life. And if you're on this planet long enough, you were around when there were only those two different types, term and whole life. But policies have evolved. And so there still is term life insurance, and I'll describe that in a moment. And then there still is whole life, but that's just one form of permanent life insurance. There are two others, universal life and variable universal life, and there are subsections within those. But essentially, in the United States and most countries in the world, there are two different types of life insurance. Term, which is temporary in nature, temporary in that it lasts a set number of years, 5 years, 10 years, 15 years, 20 years, 30, sometimes longer than 30. Very few companies offer longer policies than that. And then there's your group life insurance that you have while you're working. And many people assume that when they leave working, their job, they have that insurance. They don't. They don't. They get options to continue it. Those generally are pretty cost prohibitive options.
Well, I guess that's another, just circling back, another really good reason not to just shy away from getting insurance because you have it through work. Because even if that policy through work is enough for that time, eventually you might not be working for that company anymore. And now going out to the marketplace and trying to get it at 50 or
60 years old,
much more expensive at that time.
For sure. We experience that all the time with people who thought that was going to be their insurance for their life. And then either they lost their job or they decided to leave it. Sometimes they do a quality of life change. They don't want to work in the grind anymore for these large companies, and they go to a smaller company that doesn't offer these types of benefits.
Right.
But so with term insurance, it's temporary in nature. And in this 40 years I've been working with life insurance, I have put in place thousands and thousands and thousands of life insurance policies. I've only paid out claims on 4 term life policies in 40 years. And that's why term life insurance has a very low cost associated with it, because while you could die tomorrow, you're probably not going to. And because you're probably not going to, the cost is very low. The insurance companies know how many people die on average every year. And the shorter of the term that you're covered, 10-year policy is generally the shortest term. I did mention 5 earlier, but generally it's 10-year. That policy is the lowest cost policy that you could buy. When you get to 15, it costs a little bit more. To 20, it costs quite a bit more. 30 is approaching permanent life insurance costs. And then there's permanent life insurance. Permanent life insurance is what its name implies. It's permanent. You'll always have it. You'll have it from the day you buy it till the day you die, assuming you pay the premium and fund it properly. And there are 3 different types of permanent life insurance. There is whole life insurance, which has been around for a couple of 100 years, actually.
That long?
Yes.
Wow.
Yeah, for sailors, it was actually first begun. Whole life insurance is a policy by which you pay the premium. The insurance company mixes in your premium dollars in with their general account, and in exchange, they give you a promised death benefit and a guaranteed cash value accumulation. It starts out very small, kind of like a mortgage. When you first start a mortgage, very little goes towards your principal. And as you've had the mortgage a longer time, more goes towards your principal. Same with permanent life insurance, whole life insurance. You have a little bit of cash value accumulating when later in life you have a lot of cash value accumulating. Some companies still pay dividends on whole life insurance. Most have moved to policies that don't pay dividends. But whole life insurance, everything's guaranteed. The death benefit's guaranteed, the cash value is guaranteed, and the premium is guaranteed.
Mm-hmm. So it's not going to change on you.
Not going to change. You'll have it forever at the exact same rate. Then there's universal life insurance and variable universal life insurance. They're pretty similar in nature. They kind of, I like to say they're built on the same chassis. You make your premium payment and it is no longer mixed in with the insurance company's general account. They put the money into separate accounts for you. On the universal life insurance, that's going to be a fixed interest rate account. Fixed interest rate, of course, very low. And we've been in a very long, low interest rate environment, except for a couple of years ago, it popped up for a little bit.
Thanks, COVID.
With universal life, it's not really a policy that's designed to build a lot of cash value. It's just designed to be a permanent life insurance policy with no risk to the growth of the cash value in the policy. And then finally, the variable universal life is very much the same, except a portion of your premiums is not in a fixed account. You get to choose where it's invested, subject to, of course, where the insurance companies, their options. Usually there are between 30 and 60 between different companies, different funds you can invest these assets into. These funds are called sub-accounts. They mirror mutual funds, but they are called sub-accounts. So here there is potential for growth.
And also for values to go down. I guess that probably is a good reason to review those types of policies more frequently.
Yeah, for sure. The variable universal life policies, the cash value will go up and down with the market. My little take on how the markets operate is think of bouncing a yo-yo while walking on up a flight of stairs. The yo-yo is going up and down, but you're walking up a flight of stairs. So we hope, of course, we can't rely on what the past has given us, but over time we hope to get increased performance out of the variable universal life policies. Generally speaking, these have a floor death benefit, whatever you start the policy at. For example, if it's a $1 million death benefit and the policy investments go down, it still is a $1 million death benefit policy. But you can design these policies so the death benefit increases with your cash value.
Okay, well, that's kind of nice. I mean, to know that it could be going up and that the policy is going to be there forever and that you could end up with more by the end. I mean,
yeah, there are just so many nuances within these policies, though. So they really need some much deeper descriptions than I just gave now. But these are the basics of them.
All right.
And we try to fit people into these. We like to see people have some basis of permanent life insurance in their world. But we can move. We'll mix in to have some term as well if need be for pricing.
Well, I think that's a great start. We have a break coming up here, and we're going to be back to talk a little bit more about some different unusual uses of life insurance and get into some more detail. So we'll be back after the break.
Terrific.
Welcome back. You are listening to Financial Wellness Weekly with Chartered Financial Services on WKBK. I'm Liz Newcomb.
And I'm John Benton.
And we were just talking about life insurance, what it is, what kinds of insurance there are, and why you might need life insurance or desire it. And in this next segment, we're going to talk a little bit more about some of the life events that should prompt you to consider reviewing your life insurance if you have it, or perhaps considering getting some if you don't. We're also going to talk a little bit about John's process when he's working with someone regarding life insurance. And we're also going to talk a little bit about underwriting and eligibility, as well as some less common uses of life insurance. So maybe I'll kick it off by just sharing some of those common life events that, again, should really get you thinking. You want to actually go ahead, John.
Well, There are a lot of reasons people would consider thinking about life insurance or should consider thinking about life insurance. If you have a job change, if you have that would be maybe an increase in your income and you need to protect that income. So job change is definitely one. Birth of a child.
Oh, big one.
Big one. Marriage, another big one. Divorce, another big one. Or purchasing a home or some other asset that you need to protect and make sure that there are dollars produced so that if you died, somebody would be able to stay in the house, be able to raise the child, to continue the income, to pay alimony that might need to be paid.
Yeah.
I
feel like for my clients that are really motivated to get insurance, the two biggest things are the birth of a child. I feel like it does change your whole world, and it really makes you wake up and realize, oh my gosh, like what if something happened to one of us now that there's going to be a new life in the equation? And then the home purchase. I think once you have a big mortgage, I mean, that's often the biggest investment you'll ever make. Worrying about, well, what if I can't pay the mortgage anymore? I don't want my wife to have to leave or my kids to be, stuck in a crummy apartment somewhere and uprooted. So yeah, those are really important.
And life insurance isn't something you think about once in your life and then never again. You think about it multiple times when these life events happen. And as you mentioned, you get married, you think, okay, now I've got to provide and make sure that, both of our incomes, if both people are working, if they're enough to keep the house running, that we have enough to keep the house running. And then a child comes along 5, 6, 10 years later, 2 years later. For me, it was 8 months later. These things, you've got to think about these things. And there are these milestones, and I pretty much listed them. Marriage, birth, job change. These are all things that happen in everybody's life.
Awesome. I think those are things that people can connect with, and hopefully if they're listening, that'll prompt them to really review their own life insurance policies. But I also wanted to hear from you, John, the expert, on what your process is when you're sitting with a client. What is the process that you go through with them when they're considering life insurance?
This process was changed over the course of my 40 years. It began, so 1986 was a very different time in our industry. It was more of a sale than an advice-driven thing. So, we were coached to go in, identify the need, and make the sale all in one sitting. And that's too much for people. That's way too much for people. And, I probably about 30 years ago, I started thinking about ways to make it more advisory to people. And my process follows actually the financial planning process. We identify the relationship, we collect data, we analyze the data, and we make recommendations. Very, very similar to the financial planning process. So we really we never ask somebody to buy. There is never an ask from us to buy. What there is a 4-meeting approach. Sometimes it's 3 meetings. The first meeting, we follow that I'm at a loss for words right now.
Words are hard.
Establish the relationship. So during that first meeting, we like to ask people why they are talking with us. They let them really just spill out to us what's on their mind.
Their goals and their concerns that maybe brought them in.
Sometimes they don't know, by the way. Sometimes they just know they should be thinking about it. So I help them kind of think about what some goals might be, some needs might be. So in that first meeting, it's always 30 minutes. It's never longer. There's no presentation happening in that meeting. It's just me to learn about the client and the client to learn about what we do. And if we both feel that we're good fits for each other, because something I didn't say earlier, we really only like to work with people who love the people they're planning for. If you don't love the people you're planning for, it just isn't a good fit for our firm. Yeah. It really just isn't a good fit.
We're all very family focused, and we really, I think, lead from relationship. And we want to work with people that want to work with us as well. And
exactly.
Yeah.
Exactly. So we identify what we do and what they do. And I end that call with, if you'd like to move to the next step in the process, it'll be another 30-minute call where we'll go through your needs. And I've given them what the needs are. little brochure we have. I send off to them to.
So they have some homework to help them start thinking before that next meeting about what their specific needs would be.
Yep. And this brochure is not a fill in the blank, so it's not going to give you your answers. It's intended to help your mind start thinking about what's going to be important to you for this next conversation. So I'll collect their needs, and then I'll collect their health information. I collect extremely detailed health information because on the third meeting, I'm going to give them some solutions for some of their needs, and I want to give them pricing that is accurate. I would hate to give somebody, whenever you hear an ad on television or on the radio, it's always an ad for the very best rate class for the shortest length term. And that's not what everybody needs. People need
and I
what's
think
fit
that's
them.
a really good point, John, because there is an underwriting process, right?
Yeah.
And there are a lot of health considerations that could impact the cost of insurance for every specific person, not to mention age and pre-existing conditions and things. So it sounds like you're doing that extra groundwork in advance so that they're not disappointed by being quoted a very incorrect number.
That's right. It is a garbage in, garbage out process, though. So if somebody doesn't tell me and then they go to underwriting and underwriting finds out everything, they find out everything. They used to find out everything with a lot of digging. Now there are sources that they can tap that tell them everything.
Well, tell me more about that. What is that actual happening? What is that process happening in the background?
So first off, what we're going to do is collect the detailed health information. So I'm going to ask some easy stuff: birth date, height, weight, tobacco use, marijuana product use, medications, surgery, blood and urine results. I'll go through kind of at high level all these things, and I'll get a feel for where I believe their rate class might be. If I can't figure it out myself, I reach out to our underwriting officer and we'll get a good rate class. But then when it goes into underwriting, so we're getting a little bit ahead of the cart in front of the horse, because we're only at the second meeting of my process right now. But when it does get into underwriting has access to things, and an applicant gives them access to things. They'll have access to your health records. They can write to your doctors. They can't use these things for anything else other than determining the eligibility for insurance, heavily regulated. Everybody has a prescription database. So they're going to know what prescriptions you're taking. And that's going to help them determine things. So if I don't know this on the way in, I'm not going to be able to give accurate pricing on that third meeting. So back to the process, though. So the first one is just meeting each other. The second one is I'll go through collect your needs, collect your health information, and then I take it all back. And on the third meeting, that's usually a 60 to 90 minute Zoom meeting or Teams meeting. And on that meeting, I'll present many different solutions. I'll show everything from the least costly you could purchase life insurance for up to, the best policies that are out there, my opinion of the best policies. And oftentimes we end up with a mixture of policies.
So you're really giving them options, and you're kind of helping them weigh the pros and cons, and then you're kind of tailoring the best combination of solutions given what they need and want, really. Precisely.
Again, very much like the financial planning process that you and the rest of the team follows when providing financial advice. Very, very much the same. And then at the end of this third meeting, I'll end it with, do you think we should proceed? What do you think should be the next step? That's always my question. What do you think should be the next step? And it'll be one of really three things. One, yes, let's apply for a policy. Two, no, it's not for me. Or three, we need to digest and have another meeting. And that's when the fourth meeting comes in, when we do a lot of fine tuning. And in that fourth meeting, by then, generally people know what they want to do and they let us know.
Wow. Well, it sounds like you definitely put a lot of time into making sure that you're presenting the right thing to the client and making sure it's their decision at the end of the day. It's
important. It's a very important decision that you don't think about much in life until the day when the family needs it. That's when it matters most.
So say they agree to proceed and they complete an application and it goes through underwriting, and then it comes back and they get a quote of how much their actual price would be given their specific situation. At that time, are they locked into it, or could they make changes?
So when the policy is approved, the client gets the final choice to say, yes, I accept it, or no, I don't accept it, or I'd like to change it. So up until the time when the policy is put into a person's hands, figuratively put into a person's hands, they get to choose what they want to make changes to it, if they want to make changes to it. Once a policy is in place, you can still make changes, but you can never increase the risk to the insurance company, meaning you can't increase the death benefit. You can't add on coverage to protect against a long-term care event through an acceleration of death benefit rider. You can't add these things later. You can't put that variable death benefit to make the cash value increase the death benefit. These things have to all be decided by the time the policy is finally delivered to you. On the other side, you can make changes at any time that decrease the risk to the insurance company.
Really?
So you could remove any of these riders. You can lower the death benefit. You can really make any change you want that decreases the risk to the insurance company.
Interesting. Well, that was really helpful for me, John, and I think for our listeners as well. I thought maybe we could talk now a little bit about some of the less common uses of insurance. We've talked about the basic stuff that everybody knows, right? Protecting your loved ones and your family. But I also hear people talk a lot about, life insurance specifically for business owners. And I hear words thrown around like buy, sell, and key person. You want to tell us a little bit about when that might come into play?
Sure. So there are two primary, and you just listed both of them, by the way, the two primary reasons why business people, owners and partners and key employees need life insurance. The buy-sell is the most common one that we've seen. And that's when there's a partnership or some sort of firm ownership in the company where two people are running the business, or three people or four or five, it doesn't matter how many people. And if one of them dies or becomes disabled, well, that person's spouse or heirs are now going to become partners in the business. And none of the business partners typically want that. So what they'll do is create a legal document with a lawyer, not with us, called the buy-sell agreement. And in that buy-sell agreement, they'll dictate how they're going to handle the business ownership if one of the partners dies. And typically it would be where the heirs of the deceased owner are required to sell their share in ownership to the remaining partners. And where is the business going to come up with the dollars to buy this? And it's through buy-sell life insurance. It creates instant dollars that will pay off the death benefit, that will pay the value.
So the remaining owners in the company are now in a position where they can provide cash to the beneficiaries of the person who passed away in exchange for that share of ownership.
Yep, exactly. Okay. And then the other one that's fairly common for business owners is key man insurance. I guess these days it's key person insurance. And with key person life insurance, if there's somebody that's integral to the company to make that, if that person left, died, the business would be at a substantial detriment. And what it does is it provides dollars to allow the company to source, hire, train, and retain the new employee. So this key man life insurance makes the company whole when they would have had a big loss if a key person left the company. It wouldn't be for necessarily rank and file employees. It's for key employees, ones that are the business is dependent upon.
Interesting.
Yeah, those are the two main, though, for businesses.
All right. And then there's this fun word called LIRP, I guess an acronym, which stands for Life Insurance Retirement Plan. You want to tell us a little bit about that as a use for insurance?
Yeah, this is a really neat concept. It's very Googleable, so I do suggest Googling it to anyone that I talk to LIRP about. LIRP is a process by which you use the tax efficiencies of life insurance to build and create tax-free retirement income. There are many rules around it on how it stays tax-free, so you have to follow the rules. But it's a way to use life insurance, properly funded life insurance, to provide tax-free income in retirement. The Reader's Digest version on how it's formed is you decide how much you want to contribute to the policy, And then we design a policy that forces the death benefit as low as it possibly can be for that premium, so that most of the expenses are, most of the premium dollars are not being used by expenses. It goes into the investment component of the policy. Life insurance generally builds tax deferred as it grows, and it enjoys a pretty favorable tax treatment when you take money out of life insurance, if it's properly designed and properly funded. Full disclosure, we are not tax professionals. We are not lawyers. We don't give tax advice. We don't give legal advice, but we know a thing or two about a thing or two, and we send you to the right person to help figure these things out. But in the end, when you start pulling your money out of a life insurance policy, your cost basis comes out first. There aren't any other investments like that where your own investment comes out first.
I'm thinking about some like annuities, for example, where it's last in, first out, and you've got to take out the money that's grown and pay taxes before you ever get to your principal. But life insurance is unique in that way, where you can take out the cost basis first.
As long as you follow the rules. The federal government has some rules around it. And if you violate those rules, you're not in trouble, but the tax treatment is very different. For example, if a policy becomes what's known as a modified endowment contract.
I'm thinking about back when I was taking my CFP courses and they kept saying, don't mech it up.
I always like to say MEC is not a 4-letter word. MEC, modified endowment contract. If the policy becomes a modified endowment contract, that means you funded it with more dollars than the policy should be able to take in a year. You can do that. You can fund it that way. And it will help your death benefit most likely, but it will flip the tax relationship. And now when you pull money out, then your earnings are going to come out first and your cost basis comes out last. And finally, if you take the money out before 59 and a half, if you mech'd the policy, there's a 10% penalty. Similar to what an IRA or a 401k would have.
So don't do that.
So don't mech it. Don't mech it up.
All right. Very interesting. So I can see that life insurance offers a lot of flexibility in ways other investments don't. And you can also take loans from permanent policies, right? Where if you have grown the cash value, there could be access to those funds, and that might be more favorable money to access later in life than other loans, right? With higher interest rates and things.
For sure. Again, there are rules, and you want to make sure you follow the rules. And what I mean by there are rules, if you haven't designed a policy for you to take money out of it, and you take money out of a policy,
it could lapse, right?
Hurt in some way. Yeah, it could cause the policy to lapse. It could cause you to need to make extra premium payments. If you borrow, you have to pay loan interest.
And does that go to the insurance company?
And well, that's a good question. Some of the loan interest does, some doesn't. So on these variable universal life policies, a portion of the loan interest that you pay goes back into your own account, not unlike a 401k loan. But you really want to design a policy properly if you're going to be taking money out of it. You want to work with a professional who really understands what can happen down the road,
right? Not
5 years down the road. But 30 years down the road.
Well, a good reason to be reviewing your policies once you have them as well, to make sure that they're still healthy, that you're funding them properly, and that they're meeting the goals that you set them up for.
Now, you know this, Liz, because you're in our firm, but we offer every single life insurance policy holder a review every 2 years. People don't always take the reviews. We urge them to, because you never know when somebody has a wife or a husband who were deceased before them, or they have a divorce, and maybe the ex-husband is still the beneficiary on a policy. You wouldn't want that. You wouldn't want. So a review helps us understand really 4 or 5 things: the benefits they have, the price they're paying for it, are they paying it in the most efficient way, the beneficiaries, and what the projection of the long-term benefits are going to be on the policy.
So you can run illustrations and you can tell them what it's likely to be in 20 years.
Yep. Okay. What we expect it to be like in 20 years.
Okay. Interesting. One other use of life insurance that I find very interesting, coming from a family where there's longevity, and most of my grandparents and great-grandparents have ended up in nursing homes for quite a few years at the end of life. I know that there are riders you can add to some of these permanent policies, which can help cover some of those long-term care costs. You want to tell us a little bit more about that?
Yeah. So there are really two basic different types of riders. I'm going to try not to be too technical here.
Sure.
There's a critical illness rider and a long-term care rider. Both will pay out under the same circumstances. It's just how they're treated in the policy. And these riders add a benefit called an acceleration of death benefit rider. So it's not a long-term care policy. It's not these older traditional long-term care policies. It's a life insurance policy first, and it will accelerate the death benefit. In other words, pay it out before you die for a qualified event. And that's if you can't perform 2 of the 6 activities of daily living: bathing, toileting, transferring bed to chair, feeding, continence, and dressing. If you can't do any 2 of those, or if by itself there's a cognitive impairment, these policies are eligible to pay out your benefit. These descriptions, by the way, are federally described. They are not, each insurance company doesn't have their own description for this. So if there is a long-term care event and we need to have a benefit paid out from the policy, it will start to pay down the death benefit. Different companies do things different ways, but generally it's at 2% of the death benefit monthly. So a $500,000 policy, 2% of that is $10,000 a month. It'll pay out $10,000 a month as long as the person remains eligible.
Until the death benefit is depleted, right? Until
it's paid out the death benefit. And if the person dies before the death benefit is depleted, the balance of the death benefit is paid out.
Wow. Okay. Well, really interesting. And I think something that I'd love to learn more about. I know we're running up on time here shortly, but I thought maybe we could wrap up by just saying what you can do with policies if maybe you don't end up needing them anymore at a certain time, or if maybe they're not suiting your needs and you want to make a change. What can you do, John?
Yeah. So when we review policies, sometimes people will say, well, I really don't need this anymore. And then I'll ask them if they want it, desire it. And if they don't, then we start to think about other things. And you can take cash from permanent life insurance policies that have built up cash. And that would be done through, as we said before, withdrawals, loans, or an outright surrender of the policy. An outright surrender could cause taxes, though, because anything that you get when you surrender the policy, they subtract out what you've paid into it, your cost basis, and that could cause some ordinary income taxes. Mm-hmm. So we want to be sure we do this with open eyes.
So you could surrender it, you could take out cash, or you could exchange it, doing a 1035 exchange for a different type of policy, right?
Yeah, a 1035 exchange involves using the value in a policy, rolling in the cost basis, the taxable gain, and the cash value, and creating a policy that may be more suitable for you.
Okay. So a new or different policy is possible.
Yes.
Awesome. Well, John, thank you so much. It was great to learn more about life insurance today. It was absolutely fun. This has been Financial Wellness Weekly with Chartered Financial Services on WKBK Keene. Give us a call at 1-800-549-6007 to learn more.